maximizing cash flow and minimizing risk. So as a real estate investor, business owner, this is probably what you're most interested in or interested in understanding which loan type offers the best terms for your specific investment needs, such as the interest rates, the ease of approval, or how each loan type impacts your cash flow as well as your returns, your investment returns. And so let's talk about specifically two different loan programs for asset-based loans as well as debt service coverage ratio loans. And what are the differences? And not only what are the differences, but which ones are best for you and your particular needs. So the first thing we probably should do is establish a baseline of what are the differences. So let's start with the underwriting criteria. How do I qualify, or how does the property qualify, or how does the deal qualify? So for real estate asset-based lenders, which we're one, the lenders evaluate loans based on the value of the underlying property or asset. So what is that value? What is that property worth? They focus on the collateral and may even consider other factors like the property type or location or condition. Because we're looking at if we have to take over this asset or foreclose, what can we get back for that property? I mean, be honest with us, that's what we're looking at. For debt service coverage ratio lenders, they're underwritten based on the projected cash flows of the investment property, right? So, and instead of relying on your personal income, the debt service coverage lenders will assess the property's ability to generate income and service that debt, right? So that's number one, the underwriting basis. So number two is the risk assessment. So and we talked a little bit about that. So real estate asset-based lenders, we're looking at the property's value and condition, right? And we're also concerned about the asset's marketability and potential resale value, what I just talked about before. But the debt service coverage ratio lenders, the lenders focus on the property's financial health, meaning that debt service coverage ratio, and that's calculated by dividing the net operating income by the total debt service. And that helps us determine the risk for default. So like a higher debt service coverage ratio will suggest a better financial stability, while a lower debt service coverage ratio indicates a higher risk associated with that deal. And so number three, so you're like, well, what are the interest rates? Well, real estate asset-based lenders, the interest rate, it can vary based on several factors, the property's characteristics, but typically the personal creditworthiness uh, will play a role. So like for us, that credit score, the better the credit score, the lower the interest rate for us. And most of the and what I'm talking about is not a hard money loan, like a 30-year mortgage note. That's kind of what we're looking for in offering you a 30-year mortgage on investment property. Well, DSCR lenders, the ratio is impacted by the interest rate. So typically, the higher the debt service coverage ratio would be a lower interest rate, where higher ratios will result in that higher interest rate. Well, now a lot of time, most of the ones that I also see, they're looking at credit score as well. So, the higher the credit score, the lower the rate. All right, so now we got this baseline. So which one um will have the highest profit potential, right, between the two? So real estate asset-based loans, there these are typically ideal when you want to leverage the property's value uh, to maximize profits. It's so like if you have a property with a really strong market value or a significant appreciation potential, a lot of times the asset-based loans will allow you to tap into that equity. So, and maybe a lot of investors will use our loans especially if they're not in a position to stabilize the income of the property, but want a a really good 30-year mortgage um, uh, term for the property. So typically, uh, you know, if you're banking on that higher value over time, you know, fix and flip projects are good. Property development, or you just confident that future growth for that value is going to continue to go up. Where with debt service coverage ratio loans, from a profitability standpoint or profit potential standpoint, it's all about that debt service, right? It's all about generating sufficient income to cover that debt service. And as long as you have the ability to maintain a positive cash flow, um, and and as long as you have that cash flow that lead to long-term profitability, then the SCR might be a situation, or you might want to opt for DSCR loans when you're investing in those income producing properties where you clearly know the income. And for those rental properties, commercial properties, especially they're especially value when you prioritize constant cash flow over short-term appreciation. But I mean, I might be a little biased only because we internally we do asset-based loans, and we have 30-year mortgages. But like feel free. I mean, we also broker the debt service coverage ratio loans. So if there's a better um terms for you, we're happy to quote from us as well as the others. But like it just really depends on, and then below, just go to fundsforinvestor.com and we'll be happy to give you a quote on both. All right. Hey, thanks for watching.